Okay, everyone, we are going to get started. Earnings season is always an unpredictable time, and there's a huge interest in options among our audience. So we brought in basically the #1 earnings and options guy. I don't know if you're familiar with Andrew Keene, but he's a very experienced trader. He was on the CBOE for 11 years. He's the founder of KeeneOnTheMarket.com. Now, if you watch Bloomberg TV, he is on constantly during earnings season, giving trading ideas and how to manage risk. So we are going to get started right away. Andrew, how are you doing?
Good. Thanks for having me.
Okay, we're going to move on. So why don't we just give a broad overview of your approach towards trading earnings before we get into specifics?
Yeah, basically, the way I trade earnings is very systematic and methodical. I look at every single component of earnings and I come up with a trading plan. I have a book that's getting published by Wiley and it's going to be out in August, and one of my big components is trading earnings. I have two bread and butter products of trading equity options. One is using unusual option activity, which is using the trades from the floor by the institutional firms to place trades, and the other one is the earnings catalyst. So I love to trade earnings. Today, I run a live trading room where we trade equity options throughout the course of the day. We went over 6 earnings trades today, and then I take all the positions in real time in front of everybody with my own money.
Okay, why don't we take a quick step back? So, how many stocks are you looking at once, and how many trades do you tend to have on in the course of a day?
I usually have on about 40 to 60 positions. When I was trading on the floor, I was a market maker in over 125 different classes. And I was looking at my old confirms in 2008. I traded like 270 different stocks. But I can absorb that kind of information. I'm fine with managing that. In general, I know all my positions in every stock. Every single trade I put on is a risk versus reward setup. So I will never sell calls naked. I don't sell straddles naked. I don't sell puts naked. I don't do any of those. I do a lot of call butterflies, put butterflies. I did a straddle swap, which we're going to talk about later, in Amazon. That worked out pretty well. So every single thing I do is a risk versus reward setup. I know how much I'm risking per trade. I can do it as a dollar amount, or I can do it as a percentage of my total book. And then, I know how to manage these. I've been trading for 12 years. I've been trading a very large book for 12 years, so I know when I want to get out of certain trades. So in Qualcomm, for example, I did a put butterfly, and I put it on for 59 cents. And then I have different rules for different setups. In a call or put butterfly, I usually take off half, and then when the trade works out, and then I leave the other half to expiration. I always know every single trade how much I'm willing to risk and what my potential reward is.
Okay, I think one interesting thing is you said specifically you don't use stops. Now, that's always a popular topic of conversation when it comes to active trading. Why don't you use stops?
In my opinion, the option is a stop. So the equity option market is only open from 8:30 a.m. to 3 p.m. Stocks are open from 6 a.m. to 7 p.m. The futures market is open 23.25 hours a day, and the currency market's open 24 hours a day. So stocks can actually gap, and they actually have a lot more risk than anything else. Overnight gap risk, right? So if I trade futures or Forex, which I also do trade, I put stops in those. But on every single trade I look at, I don't say, hey, if this trade works out, how much can I make? I always say, hey, let's say this trade goes rogue and goes against me, what's the most I can lose? So I know the option market, the option trade I'm putting on is already my stop.
Okay, so if you have a trade that goes against you, so do you just let it ride, or
it depends on the setup. Get out? Like today, I had a perfect example. In one of my trading plans is I watched for unusual order flow. So I saw someone sell a bunch of puts in Dendron, and I said I took a long position. It was losing money, and I said I wasn't going to cover that position till I saw the big institutional trader that was long as well get out of his position. So today he covered some of his position. So then I took a loser on my position. So sometimes I do take, positions off. From my point of view, in earnings, there's a lot of weekly options, and I would rather trade the weekly options if possible. Obviously, every stock doesn't have weekly options, but if possible, I'd rather trade the weekly options, get the catalyst over with, and then move on to the next trade.
Oh, okay, excellent. So let's move on to another very important topic, which I think a lot of people have trouble with, especially with options, is position sizing. Now, you have this ranking system, which I would assume is just how confident you are in a trade. Now, how often are you in category 1 where you are making a huge bet?
I've had one of those this year, and it was Las Vegas Sands. It was unusual option activity. I saw a trader buy over 15,000 Las Vegas Sands. It was made 52.5 calls, so I had a huge position on in Las Vegas Sands. And then when the chart lined up for me to get out of it, I got out of it. But most of my trades are 4 or 5 on my confidence scale. Like I said, I like to trade a lot of positions. I like to have a lot of different, bets sprinkled across the playing field. This keeps me in the game longer. If I had 4 positions and I lose all my money in one position, I just lost 25% of my total book. So I'd rather play, small ball, hit singles, try to get some steals, and always go in for home runs.
Okay, so so unusual options activity, is that something that will push you into those bigger trades?
Yeah, I mean, basically in the trading room that I run, the course of the day, in the morning is the unusual option activity and trading on the unusual option activity. And then in the afternoon, we devote an hour and a half straight just to earnings. And I do trade a lot of earnings. Like I said, I have positions on, just today I initiated new positions on Goodyear Tire, Amazon, SWKS, CRUS, NetSuite, and one other one. So I initiated 6 new trades for earnings today. So unusual option activity and earnings. Obviously, when the earnings is, lingers down a little bit, I'll go more to unusual option activity. And whatever, if earnings aren't treating me as well, making money, then I'll go back to unusual option activity.
Okay, but I mean, overall, in the course of a year, how much of your profitability comes from earnings season rather than the rest of the time?
To be honest, I've never netted out what percentage goes to earnings versus unusual option activity. I just look at the net of the total book. We send an email spreadsheet out to every customer of every trade that we put on in the trading room, and it's up like 30% this year. So we have all the initial positions and all the opening positions, and anytime I get out of trades, I announce it to the trading room. We also do a premium Twitter, and we announce all the trades on there as well.
Okay, so, but, I mean, would it be fair to say that you view earnings season as kind of ripe with opportunity?
Oh, of course. I always say for a trader, it doesn't matter, it shouldn't matter if the market goes up or down. You just want volatility and you want movement, right? So I don't really care if the market's up or down. I just want volatility, I want movement. I want, and earnings always has volatility and movement. I have a way of looking at the at-the-money straddle. I look at calls and puts to try to get measured move targets. And then I bring up the chart, and then I put on a risk versus reward setup for every single earnings.
Okay, all right, we have a question. So what is hem cribbit, or whatever that word is?
If you want to go back to the slide, I think it was described in the last slide.
Oh, is that the acronym for the...
Yeah.
Oh, yeah. Oh, yeah, I should have gotten that. Okay, yeah, that is just the acronyms for slide 4, if you go through the letters.
I'll go over this really quickly. And this is, a systematic trading plan that I created, and I took from the trading floor. Now I'm trading upstairs like everybody else. I have 7 monitors and, 2 computers that I'm watching all day long. And this is just a systematic way of looking at everything on earnings. So the first thing, I call it the H, is historical movement. I look to see how the stock has performed over the last 8 quarters. I look to see if the stock's gone up or down, and the percentage has gone up or down. So I look to see over the last 8 quarters, in history, just for example, Safeway came out and had poor earnings yesterday, right? I look back, over the last 8 quarters, the stock has sold off 7 of the last 8 quarters. So that makes me get a little bearish sentiment in my head. I had one today, SWKS. That stock has rallied 7 of the last 8 quarters on earnings. So that gives me a good gauge. I have a lot of analogies for trading, and one of them is a sports team. If you guys are in New York, so if the Knicks win 8 games in a row, is there a better chance they win or lose the next game? And that's how I look at the historical movement on earnings. Then the next thing I look at is the implied movement. And it works best with the weekly options, and then it works a little not as well with the May options. I add the calls and the puts together, and I add them to the strike price, and it gives me two quote-unquote measured move targets, one to the upside and one to the downside. That's how much the market makers, the big money, the big firms, are implying the stock can move on earnings. Then I look at the chart. If I always say, if someone put a gun to my head and had me choose a measure move target up or down, but I think it's going up or down based on the chart. And I use a lot of technical analysis. I use a Japanese technical analysis that's getting a little bit more, used on the Western Hemisphere for that. When I have all that, then I can think of a trade that I possibly want to put on. So then I'll put on a trade. Every single trade I said, I put on a risk versus reward setup. How much am I willing to risk? What is my potential reward? Then I have break-even points. I want to know where are my break-even points. How does that compare to the chart? Resistance, support, Fibonacci levels as well. Then I always call it TNT. I have a time frame of when the trade is going to be over, and I have a target. So I know on most of my call and put butterflies, I take off half the next day, and I leave half till expiration. If I have a call spread, maybe I'll let the whole thing ride. I always have an idea in my head of my target and when I want to take it off. So for the trading room, every single day, I go through this trading plan, every single one for earnings, all these 9 steps to help me put on a trade.
Okay. Speaking of volatility, so as everyone's aware, the other day there was that fake AP tweet that, the Dow dropped about 150 points intraday. Now, when you saw that, did you have any reaction? Did you make any trades based upon that dip?
One of the main indicators I look at is the VIX and the VXX. So I actually saw, and I watched the VXX and the VIX, and the VXX started spiking actually before the futures started selling off. So they spiked, the VXX spiked up, and I'm also on Twitter all day long too. So you see these a lot of the news feed you get on Twitter faster than you get anywhere else on TV or anything else. So I saw the VXX initially starting to spike, and it spiked like $1, and then the VIX spiked, and then I saw the futures sell off, and it didn't last very long, and I would say 80% of my book are long positions. So obviously that it's like, oh, maybe I should get out of some positions. Something's obviously going on, right? We have the futures are sold off 13 handles in a course of a couple minutes, and then they climb right back. It was less than a 5-minute move though.
Okay, and do you attribute a lot of that to algorithmic trading or anything like that?
Well, you hear a rumor that the White House gets bombed and Obama's injured. Obviously, the market's probably going to sell off on that news. So, obviously it got hacked into. I don't think that's algo-based. S&P 500 futures are the highest algo-based product. They are more manipulated than any other product out there. And I compare option trading and earnings and unusual option activity to a game of poker versus a game of chess. A game of chess is like algo trading, and the algos and the computers are always going to win. But in option trading, there's so many different variables, just like playing Texas Hold'em in poker, that you can't read bluffs, or you can't see what the trade actually is. They could have a hedge. They could have a hedge on a stock position on against it. So it's a lot more complicated and complex than just algo-based trading.
But do you see any of that influence at all within the options markets?
Not as much, no. Like I said, I watch about 2,000 trades during a day, and I take probably 3 to 5 of those trades during the day. And when I see trades go up, calls are bought for 1 or 2 reasons. They're bought as speculation or a hedge. That's it. So they're speculation to the upside or a hedge against a short stock position. Puts are bought for 2 reasons: speculation to the downside or a hedge against a long stock position. And my best quality or my best attribute in trading is reading order flow. I did it for 10 years on the trading floor. We knew, once a week we would have someone I was a Merrill Lynch broker in Apple. He would sell put spread every single week in Apple for a year and a half. So we knew when that guy was coming around the corner, he was A, selling implied volatility, and B, he was getting long. So I watch all this order flow, and then I base a lot of my trades on it. So being able to read this order flow is something that can't be taught overnight, can't be taught in 6 months. I've been doing it for 12 years, and this is, why I am where I am right now.
Okay, we're going to get on to strategies in a second, but before we do that, I feel like your strategies tend to be more simple meat and potatoes strategies. Do you ever like move into the more esoteric realms of options trading, or is it for you mostly straight ahead spreads and butterflies and things like that?
No, I would say my strategies are actually probably a lot more complex than most people. You know, most traders just work with simple calls or puts, but you know, I do a lot of straddle swaps, calendar spreads, strangle swaps, butterflies, you know, broken wing butterflies. I basically can do a strategy based on anything. So I think mine, and you know, one of my things I get told a lot is I have to kind of, you know, lower, you know, some of the like tone it down a little bit so it's not so complex. You know, options themselves are complex. There's 21 different strategies, and I try to basically employ all of them in my trading.
Okay, all right, so why don't we move on to strategy? So let's talk about first the bull call spread. So why don't you tell people what you're seeing with this strategy?
Yeah, so a bull call spread, you know, I did these on earnings. I did one in Akamine. I bought the May 39.41 bull call spread. Stock was trading around $37. We had a measured move target up to 40.20. Akamine just blew out their number, went up to $43. So on Wednesday, I bought the 39.41 bull call spread for 47-cent debit. Every option is equal to 100 shares of stock. So a one lot is $47 at risk. My maximum reward at expiration, it could be worth $2, so 153. So if you just do a simple reward to risk setup, I'm getting 3-to-1 reward to risk. If it goes above $41, then I'm getting over 3 times my money on this trade. And this is part of the reason you get 300% return, you know, on a, you know, basically a 10% stock move. If the stock moves 10%, I can get 300% on my options. My break even on this trade was 39.47. As we all know, Akamine soared to the upside. It's trading 43. There's still going to be a little premium in it. They were May options instead of the April weeklies. There were no April weeklies. In general, on earnings, if there's April weeklies, I always try to trade the weeklies instead of the Mays. So I took off half that position today at $1.60, and I'll leave the other half to expiration.
Okay, that's a good explanation. So, I mean, in general, do you think maybe particularly individual investors don't use spreads enough, and they use, you know, straight purchases of puts and calls too much?
Absolutely.
Like, okay. All right. So we have other spread trades in this presentation, but we're going to skip over them because the math is very similar. But if you want these slides, we will make them available so you can download them so you get all the information. But in the interest of time and being able to answer more questions, we're going to move on to the butterflies. So Andrew, why don't you talk about butterflies for a little bit?
Yeah, butterflies are my favorite strategy that I have out there. And basically, when I do them for earnings, I'm usually buying out of the money butterflies. So I'm buying a lower strike, let's say they're call butterflies. I'm buying a lower strike call, selling 2 middle strike calls, and then buying an upper strike call. You know, stocks can basically go 7 different directions. It can go parabolic higher, it can go up on a 45-degree angle, up on a 15-degree angle, flat, and the same way down. This is a good strategy if I think the stock is going to make a move to the measured move target, but it's going to stop right there. If I thought the stock was going to go parabolic higher, then I would just want to buy calls outright. Because on a call fly, part of the reason, you know, that it doesn't work out so well sometimes is if it moves too much. The measured move moves too much. So on Akamine, I happen to have call spreads instead of call flies. If I had call butterflies on, I probably would have lost money on it. So I love call butterflies because instead of getting 3-to-1 on a call spread, I can get 5-to-1, 6-to-1 on a call butterfly, and I'm still going to have a huge, huge range where I make money on that trade. And when we talked about the HIM Cribbit trading plan, we always have a measured move target. And whatever that measured move target is, I usually sell the measured move target. So I always look to short the measured move target, and that's my middle strike.
So just to recap quickly, so this is a good strategy if you have a very specific target price for a stock?
Yes.
Is that fair to say?
Yeah, you know, a lot of these stocks that I trade, you know, I'll trade anything with options. There's 8,700 stocks, there's 3,200 stocks with options, and there's about 300 ETFs with options. So I had one today I'm looking at right now is SWKS. We had a measured move target to $25. I bought the 23, 25, 27 call butterfly. This is the same as buying the 23, 25 bull call spread to sell the 25-27 bear call spread. And I put this on for, I think around 40 cents. So I was risking $40, and my potential profit could be $160. And I'm also still going to have a range of about $3.60 where I still make money on this trade.
Okay, so let's wind back for 1 second. So when you're looking at particular stocks or ETFs, do you have liquidity requirements? Because, I mean, I've noticed on a lot of small caps and mid caps that you'll see extremely wide spreads on the bid-ask on the options prices. So how do you look at that?
I never ever leg into spreads. I will always put them in the spread book. So there's certain brokers that don't have spread books. If you're looking to trade spreads and your broker doesn't have a spread book, I would probably say go somewhere else. And the way that it is basically, let's say a spread market's really wide, and we had an example today in the letter N, NetSuite. And the market is, this is an old market maker trick, right? The market is, let's say, 30 cents at $1, okay? Very, very wide market. I know, as a market maker, it is worth exactly the middle. What anything is worth in this world is what someone's willing to pay, someone's willing to sell it for. And the middle is mid-market. That's exactly what it's worth. So if it's 30 bid at $1, right, then I know the midpoint is 65 cents, 35 cents up and 35 cents down. So I know it's worth 65 cents. I know that there's companies such as Goldman Sachs and Citadel that will fill my order as long as there's quote-unquote theoretical edge. I mean, if I put 1,000 lot, probably won't get filled. If I put a 20 lot, I will get filled. So I can bid 70 cents because in theory it's only worth 65. And I will get filled. So yes, there's liquidity in there, but figure out exactly the middle point. If I want to buy it, I buy it for maybe 5 cents over. If I want to sell it for maybe 5 cents under.
So basically, you have to decide if the opportunity is worth just giving a little extra?
Well, yeah, basically. You know, you have to, in trading, you know, I give up a little bit of theoretical edge. You know, I had a call butterfly in NetSuite. This is a perfect example. It's 25 cents at $1. And I wanted to get in this trade, and I wanted to get in as close to, you know, the value of its worth. And I know how much it's worth based on the way the markets are. So I give up maybe 5 cents of edge to get in this trade. You know, in the spread books, depends what you're trading. You know, if you're trading a stock the day before earnings, the markets might be pretty wide. If you're trading Bank of America, it's going to be a penny wide.
Okay, and to be clear, when you say spread book, do you just mean like specific pricing for different spread strategies?
Certain brokers have an order where spreads will go. Certain brokers don't have that book, okay? So I can enter, if I do a call spread, let's say, I will never leg into the spread where I buy one call and then I wait and I sell other call. You can physically put the order in as a condor or butterfly or call spread or put spread into what's called a spread book, and that's open for everybody to trade.
Okay, we have another question. So what broker do you do your trading through?
I am currently trading at Interactive Brokers. When I left the trading floor, I basically shot myself around, and they had the cheapest commissions, so I went there. As a retail customer, they don't have a lot of the bells and whistles. They do not have a lot of, you know, cool features that other brokers have, but they were the cheapest commissions.
Okay, all right. So we are going to move on to straddle swaps.
Okay, straddle swap. This is a very, you know, I consider this a little bit more complex strategy, and I actually did it today in Amazon, and so far, so good. So Amazon, I look at the at-the-money straddle, and I figure out how much the markets are implying it's going to move. In Amazon today, the at-the-money straddle, the at-the-money puts, and the at-the-money calls are priced at $20. So they're applying a $20 move in Amazon. I did not think Amazon was going to move $20. I thought it was going to move less than that. Apple moved less last couple quarters. They were implying about a 7% move in Amazon the last 2 quarters. It's only moved about 5%. So I thought, you know, what I want to do. I can't sell a straddle naked because that means blowout risk. If anytime you sell calls, and selling calls is actually riskier than selling puts because calls can in theory go to limited, stocks can go to limited, and to the downside stocks can only go to zero. So what I did today in Amazon, I bought the May 17th expiration 275 straddle, the $275 straddle, and then I sold the April weekly $275 straddle. And the way that we know that gamma is always highest in the front month, right before earnings, volatility is also highest in the front month, and then it starts leveling off. So I did this straddle swap where I bought the May 17th expiration, and I sold the April weekly expiration for $3.85. So my risk on this trade was $385 for one lot. My reward on this trade, in theory, is unlimited. I want the stock to close as close to 275 as possible. My break-evens is going to be a little bit more complicated because it matters how much the May implied volatility moves. But basically what I want to do is I want to take advantage. And the best thing about trading in the options is I can put on a strategy based any way I think. If I think Amazon's going to move up parabolic, like we talked about the 7 different ways that stocks can move. I thought Amazon was going to either go down, sit between the 15% up or down. So I did a straddle swap. If Amazon sits right here tomorrow, I should be able to get at least a double on this trade, and I'll probably take this trade off on the opening bell. And now I see Amazon's only up about $4. So this is a straddle swap, taking advantage of higher implied volatility in the front line.
Okay. Okay, so we are going to move on to unusual options activity. So why don't you talk a little bit about this? This is what you saw on April 22nd, some of the big trades. Now, I think it would be helpful to explain what paper is. I see you use that term a lot on Twitter.
Yeah. So we work with a proprietary software that shows me every single trade across every single exchange. And I watch about 2,000 trades in a day, and I always talk about paper. And paper is just an order from a hedge fund, mutual fund, retail bank, or a big trade. So as I watch throughout the course of the day, I'm not watching the 20 lots or the 50 lots. I'm watching huge orders, 3,000, 10,000. Today in FIO, they reported earnings. Someone came in and bought 26,000 SEP 24 calls for $1. That is a ginormous order. That's $2.6 million worth of premium that one trader bought. We never know who this trader is. We don't know if he has a stock position on against it. But I looked at that right away, and a light bulb goes off. I go, 26,000 options are bought. That's a ginormous order. So in FIO, I jumped on that trade, and they're up like 10% already. So I did jump on that trade. So if we look at here, this is what I look at. Okay. So the first one, paper sold 1,950 COH. May 26 puts for 85 cents. And then every single stocks have usual volume in a day. Apple trades 15 million shares. Something that is unusual is X times usual volume. So Coach, at that current time, it was trading 2.2 times the usual option volume in Coach, and that's a time-weighted option volume. So I want to see the higher the better. As I look right here, these are all 2, 2.3, 2.8. I didn't take any of these trades. I know these KBH ones they talked about on CNBC, and I think those KBH calls went up to like $1.50. So I watch all these trades going across the tape, and then, as I go through my trading plan, and I have a similar trading plan to the HIM Cribbit, to the Oak Ribbit, is I look at these trades, I look at the chart, I look at a risk versus reward setup, and out of 2,000 trades in a day, I try to choose the best 2 to 5 trades per day based on unusual option activity.
Okay. So there's a mountain of questions, so we are going to skip the last slide now, just as a reminder to everyone. We will make the slides and the video available, so you won't miss anything. I think best thing to do is to go straight to the questions because there are so many. On the screen, you'll see contact information if you want to get in touch with Andrew. Andrew has a new book coming out. If you want to email us, we have everything. But I think now best thing is to go straight to the Q&A. And so first question is, can you make money just buying puts and calls?
Can you make money? Yes. I think you're taking away some of, you know, if you're buying puts and calls, you're always buying implied volatility. And part of the reason is that you don't know as an average retail trader if implied volatility is considered rich or cheap. So can you make money? Of course you can make money, but if you put in some more strategy into the trading plan, then, you know, I compare it to a baseball player. Can a baseball player, you know, be a successful player if he can't hit a curveball? Yeah, he'll be a successful trader, you know, a successful baseball player, but he'll never be like the best in the league or never be on an all-star team. So yes, you can make money. A lot of my unusual option activity, I do simple calls and puts. Sometimes I do spreads. Most of my earnings are spreads.
Okay, so next question is, do you trade options on indexes and ETFs like the SPY?
I do, not as actively. You know, my big thing is if you're trading SPY, XLF, you know, XHB, I don't know, any of those ETFs, if I see unusual option activity in those, they can be hedged against so many different positions. My trading plan is so much different than anybody's out there because I'm watching to see what the big institutions, the big funds are doing. You know, I'm basically swimming with the whales and trying to get their little, you know, the food they don't eat. Imagine knowing like Carl Icahn's position or David Einhorn's position before it's disclosed to the public. So I think, you know, trading SPY, trading the Dow is a net zero-sum game. Unusual option activity has kept me in the ballgame for 12 years and having consistent returns.
Oh, okay, excellent. Okay, so the next question is, Francis says, I was told that when you buy an option, you should look for low implied volatility. Now, is that true?
Well, what we used to look on the trading floor is we look at something called historical volatility versus implied volatility. In general, if the historical volatility, where the stock has moved in the past, is higher than the implied volatility where they're expecting in the future, then it's considered a cheap option. We call them cheap or rich. If the historical volatility is very low and the implied volatility is very high, then that's called an expensive option or a rich option. So there are services that do provide that. I look at that sometimes. You know, a lot of times I have trades on, I'll try to get out of the trade before earnings. I get emails all the time. Hey, I bought Amazon calls, the stock's up, I'm down money on my calls, how can this be possible, right? You got to know that when implied volatility is going to get, you know, sucked out of an option, and earnings is the biggest catalyst when it.
Okay, Andrew, you there?
Yeah, I'm here.
Oh, okay, I just cut out for 1 second. Okay, so next question is, so I think you mentioned proprietary software before, but people really want to know, where do you get these paper trades?
You can get them if you email me. I'll tell you the service that we use. I know a big one that people use is called Live Vol. It's, I don't know how much it costs, maybe $200 to $500 a month for this service. You know, in my trading room, I talk about all the trades that happen. So in my trading room, not only do you get the unusual option activity, which we leave the scanner up all day, you get my analysis of all of it, which if you looked at the scanner that I watched during the day, your head would spin because there's 2,000 trades in a day, and trying to dissect it is very, very complicated. And, you know, that's what I've learned over the last 10 years, how to read this order flow.
Okay, we have another question. Do you ever sell puts naked? I think you covered this before, but very quickly.
You know, I will if it's a very, very low price stock. So like STP, for example, I sold some June 0.5 puts. I know stocks can only go to zero. So in Apple, Amazon, Google, no, I will never sell puts naked. And, you know, I have a perfect example. When I was on the trading floor, you know, my head, you know, the head partner of my trading firm came up to me and was like, hey, we need to talk. And I was like, okay, what's up? He said, hey, if Pepsi goes down 50%, you lose $1.5 million and you're out of business. I started laughing. I said, Pepsi's never going to go down 50%. He looked at me. He said, what about they find, you know, 7 syringes in Pepsi cans in China? Well, then it can. So from that day forward, I always cover cheap puts. So I think selling puts naked is a terrible risk versus reward setup. You know, if you're a long-term trader, buy and hold, that's a different situation. But I'm a trader. I'm in and out of positions. That's not a trading strategy.
So, I mean, I feel a lot of experienced traders I've spoken to, they usually have stories of a big mega trade that went wrong and they learn from it and rebuild again. But I mean, have you ever gone from that, or have you just avoided it altogether since you never? It sounds like you don't really do those swing for the fences trades very often.
No, I mean, there's so much that I've learned. Like, you know, I clerked for a trading firm for 9 months, and then after that, then I got a trade. And even like a couple years, I didn't, you know how to trade as well as I do now. And every single day, I learn something different in trading. So I always say, and I say to everybody that works in my office that trades, you're actually never a true trader till you blow out. And I've blown out my account a couple times before, and I never realized a risk versus reward setup. When I was on the trading floor in 2008, my profit and loss swings were $20,000 a day, and I didn't care if I lost $20,000 in that stock because I knew in a different stock I'd make it up. So my trading strategy, I went from a market maker to now I'm a retail trader. So I'm upstairs just like everybody else, and I'm basically a higher level retail trader. So I'm constantly putting on positions, but always having a risk versus reward. Always saying, hey, if this stock goes against me, hey, if they say Apple is going to buy all of Europe, how much can the stock go up or down? If Apple goes to 600, if Apple goes to 100, what is the most I'm willing to lose on a trade? And I had some guy that I was doing a money show for, and he said, hey, I think Apple's going to go up. I have 85% of all my, money, trading money, in long Apple, okay? Do you think this is a good idea? I said, I think it's a terrible idea. What about they come out tomorrow and say, the iPhone might give cancer? You're out of business. So every single trade, risk versus reward. How much am I willing to risk versus how much I want to make?
Okay, great. That just wraps up the. We have another question. What is the minimum amount of money needed to trade options? I'll answer that quickly. You need to talk to specific firms. Everybody has a different minimum of what they require. So, Andrew, why don't you talk a little bit about your trading room more?
Okay, so we run a live trading room. Basically, it's open all day long. If you guys have any questions that I didn't answer, or if you have, you can email me. My email is 24/7. I send emails late at night. I'm sure many of you knows that. So my email is 24/7 whenever you want it. We run a live trading room. We have over 60 members part of our trading room, and basically it's me trading all day long. We're on live audio for 5 hours a day. The trading room is open from 8 a.m. to 4 p.m. Central Standard Time, and it's a lot of, options. This is the trading room. We have a beginners and education trading room as well, which goes over strategy. This one is a little bit more advanced. I talk very fast. I trade very fast. I'm constantly telling you, I'll show you guys any fill you want to see of any position I put on, why I'm doing a trade. I go over the unusual option activity scanner. I go over the HIM Cribbit trading plan for every single earnings. Each stock takes me about 15 minutes. So every single day in our trading room, 5 hours a day, we're constantly trading, and we're trying to get everybody to understand the concept of a risk versus reward setup. And, we have testimonials and stuff like that. But if you guys have any questions about the trading room, shoot me an email. I can get you in the trading room for a couple days for free. Check it out. Everybody that's been in there loves it.
Okay, why don't you tell us about the book? I understand it comes out in June. Is that correct?
Hopefully, yes. I've been delayed a couple times, but yes. So I came out with a book. Basically, it is incorporating earnings. Like I said, my 2 trading strategies is the HIM Cribbit and the Oak Ribbit. One is for earnings, and one of them is for trading unusual option activity. It's getting published by Wiley. It's coming out tentatively June 1st. If you go to Amazon.com and you type in Andrew Keene, you can find my book. It's on there. I'm very, very excited for this. This is the first book I've written, and now I already have ideas for book 2, 3, and 4. But this will be, anything from beginner 101 to more complex strategies, straddle, swaps, and stuff like that.
Okay, we are going to wrap it up here. So, Andrew, are there any final messages you have for everyone out there?
Final message, if you guys have any questions about trading whatsoever, options, I trade everything. I trade stock, I trade futures, I trade Forex. If you have any questions about anything, you can personally email me, and I will answer any questions. If you want to get in the live trading room, feel free. I am 34 in July. I started trading out of college. I started trading out of college when I was 22. So I've been trading for 12 years. That's all I know how to do. I don't know how to do anything else but trade. So if you guys have any questions, you can shoot me an email. I'm more than happy to let you guys come in the trade room to check it out. I want to thank Minionville for having this webinar, my first webinar with them. I'm very excited to partner with them.
Okay, Andrew, thank you very much. And everyone, thank you for attending. And just a reminder, we did record this. It will be made available. We will make the slides available for download. So just keep your email box open, and you're going to get a message from us very soon. Andrew, thank you once again for your time. We know you're a busy guy during earnings season, so we really appreciate it. And have a good day.
Thank you, Michael.